So, good afternoon, ladies and gentlemen, and welcome to the Foreign Correspondents Club of Japan. I'm sorry we're starting just a little bit late. It's my fault. Held up in talks with lawyers, if you know what that's like. I have a request first before I introduce the speaker. Can everyone sort of follow me in either muting or turning off your cell phone so as we don't get interrupted? Thank you. I've just found out we actually have two speakers today. Mr. Trey Knippa, a hedge fund manager. I'm sure many of you know him from the financial industry. And also our main speaker, Mr. James Rickards. Trey is going to speak first for 10 minutes or so. Then Mr. Rickards will speak for the rest of the period we have. As we want to create as much time as we can for Q&A, I'm going to leave my introduction there. You do have it on your sheet, explaining the many hats Mr. Rickards has worn in his long career. So can we just have a warm welcome, please, for our two guest speakers today? Thank you. So, Trey.
Howdy. My name is Trey Knippa, and as you can tell by the howdy, but you can tell by the voice, I was a trader on the floor of the Chicago Mercantile Exchange for 18 years, hence the ridiculous voice, and so I'll save you from speaking into the microphone so I don't blow your ears out. But yeah, I was a floor trader, one of the guys doing the funny hand signals, and eventually sort of transitioned my business into a hedge fund manager. I'm currently short $1.3 billion worth of Japanese government bonds. I do it through options. And I'm also long gold and yen, which is a core position that I've held. If you're going to be short a currency, and obviously I'm very excited about being short the yen because I think it's going to infinity, that if you're short a currency, you have to be short against something. So if I'm going to choose what to be short against, do I necessarily want to try to outguess the other central bankers and be short versus the euro or the Fed and be short the dollar? No, I'd rather be short versus gold. So that's a big core position. If I want to be short the yen, then I've got to be short versus something. I don't want to outguess my long leg, so my long leg happens to be gold. Also, I believe that we are in a zero yield environment. I think that most of the people in this room probably understand why. I think that that will stay that way for an inordinately amount of time, if not forever. So I started an alternative fixed income fund. There's demand for yield, simple as that. And so I go out and I try to find alternative sources for yield. And that's what I've been doing. Like I said, I was a trader on the floor for 18 years, but I moved back to Dallas. That's where I grew up. If anybody recognizes me, I own the website shortjapandebt.com. How subtle a domain name is that? And I'm a regular guest on all the financial news networks. And that's how I got hooked up here with Jim. So Jim has a newsletter called Strategic Intelligence, and he was nice enough to invite me to be a contributing editor in that newsletter. And then it just so happened, since I had a big background on my position in Japan and I've done a lot of research on it, et cetera, they were nice enough to invite me along on this trip. So this is my first trip to Japan, and it's absolutely lovely being here. I've very much enjoyed my trip so far. Thank you.
Thank you, Trey. So, Mr. Rickards.
Thank you, Peter. First of all, it's an honor and a privilege to be invited to speak to this group, the Foreign Correspondents Club of Japan. So I thank you and Peter for the invitation. Very, very appreciative of that. And certainly to second Trey's remarks, when you say you're short Japan debt and interest rates are negative, obviously the value of the debt goes up. And you say, gee, aren't you losing money on that position? But Trey is a real trader, and one of the things floor traders know is there are two legs, or it could be as many as 20 legs, for really complicated trading positions. So yeah, you can lose money being short, but make money on the other side of the trade. So it's the overall position that counts. Ultimately, you can make a fortune on this side, but you hedge your losses in the short run by making money on the other side in the meantime. So that's very sophisticated trading, and this is not just a bet against Japan, it's a multiple-sided bet. Certainly, when I got to know Trey, that came to my attention. I spent a lot of time talking about gold. We'll talk more about gold in a few seconds, but when I said, this guy is not just a Japan debt basher, he's actually a very sophisticated trader who understands that gold is a form of money, and doing government debt against gold is actually two forms of money, one against the other, so a very sophisticated position. We're happy to have Trey as a contributing editor to my newsletter, Strategic Intelligence. With that said, let me jump into my part of the presentation. I'll start with a little background, and then I have two main topics I want to cover. One is my new book coming out, The New Case for Gold, is a copy of it right here in front of you. I'll talk a little bit about that, and then I'll talk more broadly about the currency wars. Currency wars happened to be the title of my first book that came out in 2011, but lest I sound like a book salesman, it actually is an important economic thesis that you all write about and read about and hear about every day. How many headlines have you written, or how many headlines have you read that start with some variation? Oh, there's a currency war going on, between the Bank of Japan and China, or the Federal Reserve and China, or name any two countries you like. And in speaking to my reporter friends in the United States and Europe and elsewhere, I always say it's not a new currency war, it's the same currency war. It's the same currency war that's been going on since 2010. We should fully expect it to go on until 2020 or longer if the system doesn't collapse first. We'll talk a little bit about that. So I think we're all used to hearing about currency wars, but I want to put that in the context of one long war with different battles. So just by way of background, it's been my destiny, through no planning and no particular intention on my part, to come to Japan. I've been coming here for 35 years. I have visited Japan more than any other single country in the world, and I've been to many, and probably London is number two, a lot of other places. But Japan, I've been to the most. I love Japan, Japanese people, culture, history. I've immersed myself in it. Don't speak the language, sadly, but immersed myself in it as much as possible. Starting at the beginning of my career, I worked at Citibank for 10 years. I was International Tax Counsel at Citibank. My particular region was Asia, Australia, Middle East, Africa, a big piece of real estate. But at the time, late 70s, early 80s, and probably still true today, Tokyo was the most important financial center in that region that I covered. So while I might be going to Sydney, or actually ended up in Zimbabwe and Nigeria and a few other more exotic places in Africa, Tokyo was just a place that I went to the most often. After 10 years there, I left. I joined an investment bank. At the time, it was called Greenwich Capital Markets. I was later acquired through a series of mergers ended up as part of Royal Bank of Scotland, RBS. But during the time I was there, we were a small privately held company, but one of the largest dealers in government securities. So that's where, this is mid-'80s to early '90s. This is where I got my experience and immersion in U.S. government finance. Trey talked about Japanese government finance, but I was very involved in U.S. government finance. We were one of the largest dealers in U.S. government securities, one of the so-called primary dealers. That means you get to deal directly with the Federal Reserve. Well, by the late 80s, the Japanese were the largest buyers of U.S. government debt, but they had no primary dealers. The large banks and brokerage firms in Japan did not have a primary dealer. And it was very important to the Ministry of Finance and those banks to get one. On the other hand, the U.S. banks at the time, and there's some oldies but goodies, Salomon Brothers, Lehman, those names are long gone, but they were the biggest dealers on Wall Street at the time. They wanted to get into the Japanese securities markets. So you had this sort of standoff between the MOF and the Federal Reserve, the federal regulators in the U.S. We want to get into Japan. Japan wants to get into the U.S. It was very, very political. Eventually, that logjam was broken, but part of the trade-offs was that a major Japanese bank, Long-Term Credit Bank of Japan, since departed from the scene, but one of the biggest banks in the world at the time. Today, it's Shinsei. But LTCB, Long-Term Credit Bank of Japan, was allowed to acquire my firm, Greenwich Capital Markets. That gave Japan one of the earliest primary dealers, and then little by little, Salomon and others got their licenses in Japan. So, of course, with the politics of that and doing the deal, I was shuttling to Japan when the acquisition was complete. The seniors at LTCB were on my board, the board of Greenwich Capital Markets. We had board meetings, so I was just coming to Japan all the time, loved it. I then changed jobs, joined a hedge fund, a startup hedge fund, Long-Term Capital Management, LTCM, not to be confused with LTCB. I said, okay, well, now I don't have to go to Japan anymore. We were in Greenwich, Connecticut, a hedge fund with a London office, and hedge funds don't have a lot of branches. So I said, well, if I go to Japan from now on, it'll be as a tourist. Turned out not to be the case. Our management decided we wanted a Japanese office. And we did everything by the book. Lots of people in those days set up Japanese offices, just kept their head down, didn't put any signage out, said we're a rep office, played the game with the Ministry of Finance. We said, no, we're going to be above board. We're going to go into MOF and get a license. Little did we know that we were the first hedge fund in history to ask for an investment advisor's license from the Ministry of Finance. And as much as I love the Ministry of Finance, they hate to do anything for the first time. They'll do it for the second to 100th time, but don't ask them to do it the first time. Well, here we were. I said, our lawyers tell us we're entitled to this license, and we were very deferential. And it took 2 years to get the license. Probably should have taken 30 days or background checks, whatever it took. Took 2 years. But the Japanese style, as you know, they want to know you're serious. They say, well, we'll drag this out for 2 years. If these guys give up, we'll know they're not serious. But if they persist, then we'll know they are serious. And that's what it took. 2 years of me going to the Ministry of Finance, and you guys know the MOF. I mean, you know, linoleum floors, sheet metal desks left over from the 50s, the most unpretentious and yet powerful agency that one can think of. So we eventually did get that license and became the first hedge fund. So once again, I'm practically living in Japan. Interesting side story, which I've never said publicly, but I'm happy to do it in this audience. So 2 years of just blood, sweat, and tears, accountants, lawyers, compliance, politics, regulations, et cetera. We finally get the license. The license came from Japan in hard copy, and a very formal document, as you might imagine, with a seal, et cetera. It was addressed to me because I was the lawyer, the general counsel, and I knew what it was. I knew it was coming, and I opened it delicately and pulled it out, and it was very I was like, wow, we did it. 2 years, we did it. We got this recognition from Japan, and of course, it was all in Japanese, but I knew what it was because my lawyers had explained it to me, and I looked down at our license number, and it was 666. For those of you who know anything about Christian numerology, the mark of the beast, well, our behavior from then on was beastly. I shouldn't say our behavior, I should say our investment performance. Long-Term Capital Management is a firm that made $4 billion in its first 5 years and lost $4 billion in its last 2 months. You all know the story, don't need to repeat it, but LTCM became the eye of the storm during the Asian financial crisis. We were I wouldn't say bailed out, or well, let's put it this way. There was a bailout, a $4 billion bailout, no government money involved, organized at the urging of the Fed, but private sector money. But I like to say they didn't bail us out. Wall Street didn't bail us out. They bailed themselves out because we owed them $1.3 trillion in derivatives positions. And I like to say when we had gone to zero, and we were heading for zero because the spreads kept widening, we were heading for zero. I said, well, when we go to zero, and I instruct my lawyers to file for bankruptcy, I get to sleep in the next day. I said, this is a problem for all of you on Wall Street. You're going to have to pick up this $1.3 trillion and try to dump it on the other side the next day, which, by the way, would have closed every capital market in the world. We got this deal done late on a Sunday night, trying to do it before Tokyo opened. But if we had failed and we were on the way to failure, no stock exchange or bond market in the world would have opened the next day. And that's not an exaggeration. Greenspan testified to this. I had a front row seat. Peter Fisher at the New York Fed said the same thing. It didn't happen. We got the money in. We said, issued a press release, said, hey, we're back. We are now owned by Wall Street, $4 billion in new capital. Positions are good, and we spent the next year unwinding it. So the world did not come to an end, but I can promise you it was hours away. That conditioned my thinking from then on. Things that people had thought were unthinkable were suddenly very real. And it was a pivot point in my career. I went from decades as a lawyer, advisor, compliance officer, advisor to CEOs, et cetera, to having a very keen interest in risk. Candidly, I lost virtually 100% of my net worth. My attitude at the time was, I made a lot of money at Greenwich Capital. I made a lot of money at Long-Term Capital. I put it all into the fund. My attitude was, hey, I'm a lawyer. What do I know about risk? You guys won the Nobel Prize. We had 2 Nobel Prize winners, half the Harvard finance faculty, 16 PhDs, a former vice chairman of the Federal Reserve. I said, what could I possibly know that you guys don't know? So I'll put my money with you. And then it disappeared along with $4 billion of other money, most of which was our own, by the way. $2.6 billion of the $4 billion that was lost was our money. $1 billion was from our friends at UBS. And then the rest, relatively small amount of about $500 million. UBS had the money in because they sold us. We bought a call option, an at-the-money call option on our own performance because we wanted to own the whole thing. And 7-year call option, paid for it. And UBS said, well, we just sold these guys a call option. How do we hedge it? We say, oh, I know. Put the $1 billion in the fund, and we'll have a hedged position relative to the $1 billion call option. it never occurred to anyone that we could lose money. That just never crossed anyone's mind, and they lost $1 billion hedging their call option. So there we were, and then I went on to run a stock exchange after that. That stock exchange called Optimark Technologies. One of our biggest investors was Sun Masayoshi Sun of SoftBank, so they were a big backer of ours. Did a few other things along the way. So I just could never escape Japan, but I've had a diverse career in commercial banking, investment banking, hedge funds, stock exchange. Done a lot of work for the national security community in understanding financial warfare, financial threats, cyber financial threats. And then eventually I said, well, I've got enough material here for a book. So in 2011, I wrote Currency Wars. 2014, I followed up with The Death of Money. And 2016, a couple of weeks, I'm happy to say, the publication date, April 5th, for my new book, The New Case for Gold. Spend a minute on the book and the thesis of the book. It's called The New Case for Gold, with emphasis on the word new. Most of the arguments about gold are not new. They've been going back and forth between the critics, gold supporters and gold critics for decades, and even before that. But there are reasons to have gold in your portfolio that simply didn't exist 10, 20, 30 years ago. First and foremost is cyber financial warfare. I live in a wealthy part of the East Coast, not far from Greenwich, Connecticut. A certain number of billionaires hanging around. Some of them are my friends. And, billionaires don't mind reminding you that they're billionaires. And I say, well, that's interesting. What do you have? What do you own? And they go, oh, I got these stock positions and these bonds, and I'm in these banks and all this stuff. And I say, well, no, you actually don't have any of that. What you have are electrons. What you have is digital wealth, because every penny of your wealth is in digital form. Vladimir Putin has a 6,000-member cyber brigade working day and night. They're as part of the Russian military and intelligence establishment outside of Moscow to hack and potentially erase, disrupt all of these financial assets. I'm not talking about, distributed denial of service attacks. That's child's play compared to what we're talking about. I'm talking about going into these systems and erasing your wealth. Good luck reestablishing it, by the way. And just to show that I say things like this, and some people roll their eyes, like, oh, that would never happen, et cetera. Well, in 2010, the FBI and the Department of Homeland Security found a Russian attack virus in the operating system of the NASDAQ, second largest stock market in the United States. This was not some criminal gang trying to get your account number. This was Russian military and intelligence. It was found, it was disabled. A reference, July 2014, Bloomberg Magazine reported on this, so this is very well documented. Whenever I see a virus discovered, I say to myself, how many did they not discover? How many are still waiting to go off? So I'm not saying, dump all your assets and go 100% in gold. I don't recommend that, and I've never said that. But I would say any investor, institution or individual, who doesn't have about a 10% slice in physical gold, not GLD ETFs, not gold futures, not gold from the London Bullion Market Association. They'll sell you gold. Call up JP Morgan London and say, I'd like to buy a ton of gold. They'll send you a contract, you sign it, you pay. They say you now own a ton of gold. No, you don't. Read the contract. They offer what's called unallocated gold, which means they can have one bar of gold and sell it 100 times. So I can sell the same bar of gold to everybody in the room on an unallocated basis, and you all think you own gold. This is what the contract says. You all think you own gold. And that's fine as long as nobody wants to come pick up the gold. But in a panic, in a gold buying frenzy, in a financial meltdown, in a cyber attack, you say, I think I'd like to have my gold, please. Well, if 100 of you show up for the gold, they got one bar. One of you is going to get your gold, and the other 99 are going to get a termination notice. This is in the fine print of the contract. They're not going to steal your money. You're going to get a check valued at yesterday's close of business. Whatever the price of gold was yesterday, they'll send you that check. They'll say, we're terminating you early. Here's your check. Can't get your gold. And but gold's up $200 announced today. Gold's up $1,000 announced today. Sorry, you got yesterday's price. In other words, you're not going to get the protection you think you're going to get exactly when you need it most. You'll be well protected when you don't need it, and you'll be unprotected when you do need it. That's how banks work the system. So, so the only way to get around that is to own physical gold. Don't put it in a bank. That'll be the first place the government goes to confiscate it. Put it in safe, non-bank storage. They're very reputable, insured firms. I don't want to do endorsements, but Brinks, Loomis, Dunbar. There are a number of very solid names out there, but don't put it in HSBC, Goldman, or JP Morgan, or you'll never see it again. So that's a 21st century reason to own gold. But in addition to that, part of the book is basically knocking down the canards, knocking down the myths. Because you get into a discussion, and you're all reporters and journalists, and you call people to comment on gold, and they'll say, first thing they'll say is, well, don't you know, Maynard Keynes called gold a barbarous relic. You know, as if to say you're a Neanderthal or a dope if you have something nice to say about gold. Maynard Keynes never said that. He never said that. He used the phrase barbarous relic in reference to the gold exchange standard of the 1920s, a particular flawed form of gold standard. He was right. I agree with Keynes on that. That was a flawed standard, and it was a barbarous relic, and it should have been abandoned. He wasn't talking about gold. He was talking about a particular gold standard. People will say to you, well, you can't have gold. You can't have a gold standard. Gold can't support finance because there's not enough gold. So look at all the gold in the world, multiply by the market price. That gives you a number. If that's supposed to support all the trade and finance and commerce and leverage and bankers' acceptances and the whole infrastructure of digital finance, there's not enough of it to do that. Well, there's not enough at $1,200 an ounce, but there's plenty at $10,000 an ounce. In other words, it's an absurd remark because there's always enough gold. There's however much gold there is. There's always enough gold to support any financial system you like. You just have to get the price right. And this was one of the greatest economic blunders of the 20th century when Winston Churchill put England, or put the UK back on the gold standard after World War I. You know, World War I disrupted international finance by the 1920s. Major powers were looking for ways back. They wanted to go back to a gold standard, but the issue was at what price? The pre-World War I price was, in dollar equivalents, about $20.67 an ounce. It's for some pounds, given the exchange rate at the time. Churchill felt duty-bound and honor-bound to go back at the pre-World War I price, as if you were honoring a contract. But interestingly, Keynes, who was an advisor to, Churchill at the time was not prime minister, he was chancellor of the exchequer. Keynes was an advisor to the exchequer and to the Bank of England. He said, no, he said, I don't favor a gold standard, but if you want to go back to a gold standard, get the price right. You need to significantly raise the price of gold, effectively devaluing your currency, because here was the pre-war parity, right? You double the money supply. If you want to keep the price of gold here and go back to a gold standard, you've got to do one of two things. You've either got to double the price of gold or cut the money supply in half. You can bring gold up here to this price, or you can bring money down here, but they have to have this parity. By using the old price, Churchill required the Bank of England to cut the money supply. This was highly deflationary, highly depressionary, put England in a Great Depression years before the rest of the world. So Churchill later admitted that this was the greatest blunder of his life, and considering this was the person who planned the Gallipoli invasion, that was a major statement. But once again, Keynes was right about gold. So the same is true today. At $1,200 an ounce, no, that would be highly deflationary. What is the implied non-deflationary price of gold? At what price could you go back to a gold standard today without causing deflation? Well, it's a range depending on your inputs. How much gold backing do you want? 20%, 40%, 100%? What's your definition of money? Is it M0, M1? So you got to fill out those parameters. But using a conservative analysis, using M1 of Europe, China, and the United States, so it's called global M1 with 40% backing, the answer is $10,000 per ounce. So when I project $10,000 gold, it is not a made-up number. I'm not trying to get headlines. I'm not trying to get attention. It's 8th grade math. I know how much gold there is. I know what the money supply is. I know what deflation is. The implied non-deflationary price of gold on very conservative assumptions is $10,000 an ounce. If you want to use global M2 with 100% backing, which I don't recommend, I don't think is needed, but if you did, that number is closer to $50,000 an ounce. So when you hear these prices of gold, they won't happen tomorrow, but in another collapse of the international monetary system, which, by the way, has collapsed 3 times in the past 100 years. That's another thing I say, the international monetary system's heading for a collapse, and people go, oh, that'll never happen. It's happened 3 times in the past 100 years. 1914, by the way, the New York Stock Exchange was closed for 5 months. 5 months, not 5 days. 1939, we all know what happened then, a little thing called World War II, and then restored it with Bretton Woods. And 1971, when President Nixon suspended the redemption of dollars for gold and ended the Bretton Woods standard. Since then, we've sort of muddled through with a dollar standard. In 2010, President Obama tore up the dollar standard to begin the currency wars, which we'll talk about in a minute. So since then, we have no standard. There is no anchor in the international monetary system today. No gold, no dollars, no SDRs. SDRs are around, but they're not the anchor yet. There is no anchor. And I've recently had two one-on-one conversations, one with Ben Bernanke, former chairman of the Federal Reserve. Spoke with him in Korea, Seoul, Korea, and the other one was John Lipsky. Spoke to John in New York. John is the only American head of the IMF, and people say, how can that be? Americans are not allowed to head the IMF. It's always a European. But our friend Dominique Strauss-Kahn resigned unexpectedly, shall we say, and they took him a while to pick Madame Lagarde. So for a brief period of time, a few months, John Lipsky was acting head of the IMF, so he is an American and a friend of mine. What's interesting about that is Bernanke and Lipsky, head of the Fed, head of the IMF, used exactly the same word to describe the international monetary system to me. And the word was incoherent. When they said incoherent, what they meant was what I just said: no anchor, no rules of the game. It's just jump ball currency wars day after day. And no one should be surprised at the volatility. No one should be surprised at the fluctuations. I mean, the dollar strengthens 25% from 2011 to 2015. 25%. That's huge in currency space. Currency space, things are supposed to move, at the fifth decimal place in a day's trading. You don't move 25% in 4 years, but that's what happened. That's what happens in a system that has no anchor. But for those, and I include myself, and I do a lot of this, understand chaos theory and complexity theory, when you see this kind of stuff, the system's getting wobbly and it's about to go flying off into space. It's about to collapse. So it's been 40 years since the last collapse. The tempo seems to be about every 40 years. I'm not saying it's going to happen like clockwork tomorrow. I'm just saying that no one should be surprised if it does. And that's what investors need to prepare for. That's what my book is about. I'm not saying we will have a gold standard. I am saying we might have a gold standard, or we might have a hybrid of special drawing rights, the IMF World Money, and gold. But in every state of the world, gold has got to be valued at $10,000 an ounce or higher. Otherwise, it's deflationary, which is the last thing the world needs. And by the way, Paul Volcker, Ben Bernanke, Christine Lagarde, they understand this. It's not like I figured this out and they haven't figured it out. They just won't talk about it. Because why should they? They're in the paper money business. They're in the confidence business. They're in the credit expansion business. Why should they talk about gold? And they won't. But I talk about it in the book, and I hope you have the opportunity to read it and enjoy it. So just to finish up, I'd like to talk a little bit about currency wars, the subject of my first book. Again, this book came out in 2011. The finest compliment I get on this book is people who picked it up a week ago or a month ago and read it and said, wow, I was blown away. This is so timely. I was like, really, a 5-year-old book in economics is time? It's hard to do, by the way, to write about economics in a way that stays fresh. But you go in there, it talks about Ukraine, talks about natural gas, talks about the IMF, talks about the things we're talking about today that you're all talking about in your reporting. But I make a couple points in the book, and they're absolutely true today, and they have enormous explanatory power. One is that, look, if I said we're definitely going to have inflation, you wouldn't need me to tell you what to do. Everybody would know what to do. Get some gold, get some land, get some hard assets, hunker down, take a little leverage if you like, and then make a lot of money. If I said we were definitely going to have deflation, again, you would know exactly what to do. Get some bonds, get some cash. Value of cash goes up in deflation, et cetera. But what if I said we're on the knife edge of inflation or deflation? There are powerful deflationary forces which come from debt deleveraging, demographics, and technology. And actually, Japan is familiar with all three. Certainly, folks in Japan need no introduction to demographics and technology, certainly. But debt deflation, demographics, and technology are powerful deflationary forces. On the inflationary side, we have central bank policy, basically money printing, QE, QE1, QE2, QE3, QQE from the Japanese, negative interest rates from our friends in Europe, now spreading to Japan, currency wars, forward guidance, I mean, the whole Operation Twist, the whole grab bag of central bank tricks designed to get inflation. Well, we haven't had extreme deflation, certainly some deflation in Japan and some hints of it in the U.S., we haven't had extreme inflation. We haven't had either one. But that's not surprising. When these forces are pushing against each other, right, they're going to cancel each other out to a great extent. But don't think this is stable. This is dynamically unstable. It's like, again, one doesn't need to clue the Japanese audience in on earthquakes, but imagine two tectonic plates pushing against each other. That's an unstable equilibrium. It's going to snap, but which way will it snap, deflation or inflation? It could go either way. In fact, actually what you want is a robust portfolio that's prepared for both. But that's the state of the world today. So that was the first point. That has not changed. And so it's confusing. Oh, I'm ready for deflation. Well, here comes a little inflation. You know, well, I'm ready for inflation. Oh, manufacturing is declining. World trade's declining. You know, exports and imports are going down together, et cetera. So the way to understand it is two opposite forces in play at the same time. To quote F. Scott Fitzgerald, the sign of a first-rate intelligence is the ability to hold two opposed ideas in mind at the same time and still retain the ability to function. I put a lot of emphasis on that last clause. But you have to take two opposed ideas, inflation, deflation, hold them in mind at the same time and process that to really understand what's going on today. The second point I make is that the world is not always in a currency war, but when we are, they can last a very long time. What I describe as Currency War I lasted from 1921 to 1936. What I described as Currency War II lasted from 1967 to 1987 with the Louvre Accord following the Paris Accord. Currency War, so one was 15 years, one was 20 years. Currency War III began in 2010. If you go out 15 years, we're looking at 2025 to 2030. The reason currency wars last so long, they have no logical conclusion. They have no logical conclusion. The only way a currency war ends is either the system collapses or you reform the system. You can reform the system as we did at Bretton Woods or as we did at the Smithsonian Agreement, the Plaza Accord, and the Louvre Accord in the 80s, or you can let the system collapse as happened in 1914, 1939. So those are your two choices, but they don't end on their own because they just keep going back and forth. And just to wrap up, I'll offer a quote from a fictional character with a real-life author. The character is Auric Goldfinger, the antagonist of the novel Goldfinger by Ian Fleming, which, of course, is one of the most famous James Bond spy novels. But Bond kept tracking Goldfinger, and Goldfinger kept encountering Bond, first on a golf course and then later in the Swiss Alps and at his Texas ranch. And finally, Goldfinger said to Bond, "Once is happenstance, twice is coincidence, three times it's enemy action." And that was it, and then Goldfinger was out to kill Bond after that. So I would apply that to what's happened with central banks recently as a way to understand where we are today. Something went on at the sidelines of the G20 Central Bankers and Finance Ministers Conference in Shanghai on February 26. Now, I was not a fly on the wall. I didn't tap the room, so I don't want to pretend to say I can recite the conversation. But when we look at what Draghi did on March 10th, what your Kuroda did on March 15th, and what Janet Yellen did on March 16th at the ECB, the Bank of Japan, and the Federal Reserve, I would say once is happenstance, twice is coincidence, three times it's enemy action. Now, central banks are the enemy of savers and investors and everyday people because they're in the business of inflating their wealth and giving it to banks. The coordination was, the dilemma was the following. China needed to devalue, no doubt about it. China's economy is falling off a cliff. They've got limited policy tools. They can't, they've got a massive run on capital. Capital's leaving the country. How do you defend yourself when capital's leaving the country? There are only three ways. This is the impossible trinity. You can close the capital account. Well, they're not going to do that because they need to stay friends with the IMF. You can raise interest rates to keep the money at home. They're not going to do that because they'll sink their economy. Their economy is already going down. The third leg of the so-called impossible trinity, or the trilemma, is to devalue the currency. So then there are only three choices. This is Mundell Fleming, 1960, the seminal paper. Mundell won the Nobel Prize. So if you're not going to close the capital account and you're not going to raise interest rates, you must devalue the currency. There's no other way out. Now, you can be in denial about that and try to pretend it's not happening, but your capital account's going to go to zero if you give it enough time. China is obviously not going to allow their capital account to go to zero, so they have to devalue. So they figured this out last August. They do this shock devaluation. What happens? U.S. markets melt down. August 31st, U.S. investors were staring into the abyss. Our markets look like they were down about 10%, which is in a couple weeks. That's a huge shock in a couple of weeks. Looked like there was no bottom. And then finally, Janet Yellen decided not to raise interest rates in September. The market got a relief rally, et cetera. But we're still in that mode. So on the one hand, China needs to devalue. On the other hand, they can't devalue without shocking the markets, without taking Western markets down. So how do you devalue without devaluing? You get the other guys to make their currency go up. In other words, instead of the Chinese saying, we're taking our currency down, you get the Japanese and the Europeans to say, we're taking our currency up. And that's exactly what happened. So what did Draghi do on March 10th? He said, well, he did the minimum, right? 10 and 10, 10 billion more QE, 10 basis points in negative interest rates. That was the minimum. A lot of people were saying maybe he'll do 20 and 20, 30 and 30. He did 10 and 10. And then he shocked the markets by saying, by the way, we're done. That's all I want to do. So when the market expects more and you don't do it, that's tightening. He didn't raise rates, but he did, in effect, raise rates or tighten relative to expectations. The euro rallies on that. So what does Kuroda do? Everyone expects some easing, Japanese bazooka, more QQE. Now we're going to buy, flower arrangements, whatever. No, he says he does nothing. So again, relative to expectations, that's a tightening. So now the euro is screaming, the yen's screaming. What's happening to the Chinese yuan cross rate to euro and yen? It's going down. So China's getting the devaluation not by their action, but by the action of the other central banks. And finally, what's the tell, right? The tell, the giveaway in a poker game, what's the tell? The tell is if the yuan goes down against the dollar, because no, you Chinese, now you're devaluing, because the Americans are obsessed with everything dollar. They don't even look around the rest of the world, right? So the Fed eases. So Europe and Japan tighten. The Fed eases. So if China's getting the benefit of ease and the Fed's actually easing, what happens to the yuan dollar cross rate? It's unchanged. Nothing happens. So everyone's like, the Chinese didn't devalue. Look at the cross rate. But meanwhile, versus the euro and the yen, and this is the continuation of the currency wars. And how have the currency wars gone? 2009, cheap yuan. 2011, cheap dollar. 2013, cheap yen. Abenomics, right? One of the three arrows. 2014, cheap euro. How did they do that? Euro QE in January 2015, negative interest rates in June 2014. So now it's time for the U.S. and China to devalue, and Europe and Japan are going to they have to suck it up. Now because everybody would like to devalue their currencies at once. I mean, we like that, but it's a mathematical impossibility. 5 currencies can't all devalue against each other at the same time. If somebody's devaluing, somebody else is going up. That's just mathematically an identity. It can't be any other way. And so this is like the craziest thing I've ever seen. But it's like, you devalued the yuan and nobody noticed because the guys who got stronger were Europe and Japan, and the guy everyone's looking at devalues too, and so that cross rate's unchanged. So nice job. It's not even the G20, it's the G4 at this point. But I find that effective in the short run. None of this will be effective in the long run, but I find it effective in the short run. I find it remarkable, and I find it impossible to believe that was not coordinated. So the next big benchmark is April 13th, IMF, spring meeting, Washington, D.C. As we know, the G20 meet on the sidelines of the IMF. The IMF is kind of like a front for a mob that's meeting in the back room. The mob is the G20 and the G4 in particular. The IMF has got this nice facade. So they'll have the usual public agenda and public press conferences and all that, the IMF spring meeting in Washington on April 13th. But behind the scenes, I think the big four, Japan, China, US, and Europe, they're going to sit down and evaluate their handiwork and decide where to go from there. My estimate is they'll do more of the same. That China needs a break. China can't do it unilaterally. The other countries are willing to help. And my analogy here is that imagine five soldiers are fighting. Right? 5 soldiers are fighting. They're exhausted. It's a hot day. It's 30 degrees centigrade, 100 degrees Fahrenheit, and they've got one canteen. They're all thirsty, and they've got one canteen. What do? Well, everyone would like to drink the canteen, right? But you don't. You take a sip and you pass it to your your buddy, he takes a sip, passes it on. Everybody takes a sip. Nobody gets everything they want, but everybody gets something. But you have to take turns. And that's the way it is in a currency war. So, sorry, Japan and Europe, they got their weak currencies in 2013, 2014, 2015. They got a little lift, not as much as they wanted, but that's all they're getting. Now the canteen's being taken away. U.S. and China are going to take a sip, look for a stronger euro, a stronger yuan. Ben Bernanke actually came up with a name for this. We all know from the 1930s, we heard about the beggar thy neighbor devaluations. That's supposed to be a bad thing. But Bernanke said, well, the problem with beggar thy neighbor, the 1930s original currency war, he said the problem was it was uncoordinated. In other words, France devalued in 1925, and England devalued in 1931. The U.S. devalued in 1933. France and UK came back in 1936. That was a tripartite agreement. But none of it was coordinated. They just kept whacking each other until finally the system collapsed and we ended up in World War II. But what Bernanke says, if we coordinate, if everybody eases at once, for example, we can get the benefit of easing without the volatility in the cross rates. So he said, this is not beggar thy neighbor, it's enrich thy neighbor. That's a quote, by the way. That's not me putting words in his mouth. That's actually, Bernanke said that in Tokyo, October 2012. And I was shocked that a chairman of the Federal Reserve would talk about the dollar at all, because they're not supposed to. That's the Treasury's job. But for a chairman of the Federal Reserve to talk about the dollar in Japan, in a foreign country from the U.S. perspective, was shocking. So told me that Geithner had green lighted it, that he had permission from the Treasury. But Bernanke laid this out. He said, well, what was sloppy about the 30s was not the devaluation, it was the lack of coordination. So that's the mental framework for the coordination we're talking about. We've just seen it in spades. In 5 business days, 3 central banks just devalued the Chinese yuan, and China didn't do anything. So kind of neat. I'll stop there, except to say that these currency wars are not going to be over soon for the reason I mentioned. So I hope you enjoy this book, The New Case for Gold. If you want the back reference, have a look at currency. By the way, Currency Wars and my second book, The Death of Money, are available in Japanese translation from my Japanese publisher. I think it won't be until later this year that The New Case for Gold is available in Japanese, but we have a publisher, they picked up the rights. So I'll stop there, and I thank you very much.
So thank you, Mr. Rickards. Very fascinating analysis there. We're going to take questions from the working press first, then I'll open up the floor to anyone else who has questions. Sir, if you can please introduce yourself and your affiliation.
Süddeutsche Zeitung, Germany, Neidhardt. A couple of questions. The first one, what's the time horizon? I mean, Kyle Bass has been shorting the yen for, I think, almost a decade. And he has to be, he's still patient, I assume. So what's your time horizon? And then the second question is, do you have any imaginations about the mechanism? I mean, the Bank of Japan obviously is already doing protective measures, like they own now by now a third of the JGB, and eventually they will all own all the JGB. So then you don't have any leverage with the JGB if the Bank of Japan sits on everything. So do you have any idea about the mechanisms?
Sure. Well, clearly we're talking about the largest accumulation of peacetime debt in the history of the world. So me picking that and giving you a time horizon would be pretty darn tricky. That's the $20 trillion question to answer, right? But I can tell you exactly how and the mechanism in which it will happen. It will be led by the currency. Because if you think about it, I'm a bondholder, okay? I'm going to get paid back. I buy a 10-year bond, and I'm going to get paid back in yen. If you turn back the clock to April 13, when Kuroda made his big announcement, we're going to double the money supply. Remember that? What did bonds do? They went limit down 4 out of 5 nights. He said, we're going to buy an unlimited amount of bonds, and bonds went down. You go, wait a second. If they said they were going to buy an unlimited amount of wheat would go up. But that same night, the yen dropped 6 handles versus the dollar, right? So if I'm a bondholder, I say, wow, I'm going to get paid back in a currency that they're clearly going after and trying to devalue. So it'll start with the currency. The bondholder says, yuck, I don't want to own this. I don't want to get paid back in wampum, right, is what Kyle Bass says. So the bondholder starts selling. What's the Bank of Japan policy response? Simple. buy more bonds, right? Then the currency accelerates lower. So can I put a time horizon of when that's going to happen? Of course not. But that is how the story will unfold. It will be led by the currencies, and we've seen that happen before. What did rates do in Brazil, Argentina? What did rates do in Russia when the ruble was collapsing? Rates went up, and that's what I think will happen here. And I do disagree a little bit about the notion of buying all the JGBs. I think wouldn't you have to take the current money supply and multiply it somewhere in the neighborhood of 26 in order to do that? Well, if you're multiplying the current money supply by 26, that sounds like a rather weak currency to me. Just a hunch. I mean, I'm not that great at math, but that sounds like a lot to me. So the positions that my $1.3 billion bet against the bonds, right? I do it with options. And anybody's watched on CNBC and the financial networks, Bloomberg, whatever, in the corner they quote the VIX, which is the implied volatility for any of you options traders. It's the implied volatility on the stock market. Stock market goes down, the VIX goes up because people are buying options. You know what the VIX is on the JGB? 0.8. Okay, that sounds like a pretty cheap option. So for me, I have this massive levered bet, but my exposure is very, very small. And in the meantime, I hedge it going to the currency. That's all I'm doing. I wish I knew when. If somebody will tell you, let me know. Yeah. I'll double my position, maybe triple it.
I agree with Trey that the currency is the tell. Think of the global financial system as sovereign debt as a sick patient. Well, how do we figure out how sick the patient is? Well, put a thermometer in his mouth or her mouth and check it out. Do you have 100 fever or 103? So currencies are like the temperature, canary in a coal mine, whatever metaphor you want to use. It's a way to measure the illness of an economy, even if it's not showing up in other ways such as bond prices, stock markets, et cetera. Because, and this actually kind of goes back to what I was saying about cyber financial warfare. You pick a currency. Could be yen, could be dollars. You've got some American will be dollars, Japanese will be yen, whatever. It's some frame of reference. What good does all the wealth in the world do you if it's denominated in a currency and that currency goes to zero? That's why the currency is so important. So I agree with Trey on that. As far as the mechanics of it, I agree completely that you cannot know the exact time. But that doesn't mean you just throw up your hands and say, well, maybe this will never happen. There are some things you can know using the scientific methods I use, which are basically complexity theory, behavioral economics, Bayes' theorem, and some other methods. You can know the order of magnitude of the collapse. You can know how big it will be. And this will be far bigger than 2008. So when this financial collapse that I'm talking about comes, it'll be far bigger than 2008, which will require even more draconian solutions involving reliquefying the world with trillions of SDRs coming from the IMF. You can also know that the degree of certainty with which it'll happen. So I look at something that's, in my view, close to certain to happen and of unprecedented magnitude. Don't know the exact timing. I know that we get closer every day. But what I say to myself as an investor is, what are you waiting for? Because when it happens, it will happen very quickly. You will not, I have people that literally say, in effect, hey, Jim, I like your analysis. Call me 3 o'clock the day before and let me know, and I'll sell my stocks and buy some gold. And I say, I'm not going to know the day before, and neither will you, neither will anybody else. But I'll tell you this, when it does happen, you won't be able to get gold. Because you'll be watching the price go up on TV, and you'll call a dealer if you actually care, and you won't be able to get it. Dealers will be sold out, mints will be backordered, et cetera. So I'm like, well, but then it's too late. So prepare yourself now for the inevitable. When it happens, you get a good night's sleep.
Can I follow up?
Yeah, sure.
The line of defense of the Japanese officials is not my line, is that 93% of the Japanese bonds are held by Japanese entities, though they don't care so much about the currency because it's domestic. What's your answer to that?
Well, I would say that it's a weakness, not a strength, that it's all concentrated in certain hands. And I would disagree. I mean, it happened in April of 2013. They started selling because the currency was weak. So, I mean, I get what you're saying, but those investors, at the end of the day, they're either fiduciaries for somebody else, and they do have that fiduciary responsibility, and they are governed by at least some self-interest. And if I'm governed by some self-interest and I see the currency that I'm going to get it paid back in is going down, well, then you bet I'm going to start liquidating some stuff. I have heard that you know what JGBs need? They need demand from the outside world, not lack of demand from the outside world, but that's going to take yield, and that's yield that you can't afford, right?
And Japanese investors may not care about the yen. I actually think they do. If your yen only gets you 1/10 of what it did before, you're going to care. But I'll tell you what Japanese investors do care about: negative interest rates. As you know, I've seen it reported, the sale of safes in this country is skyrocketing. People are saying, well, just get some paper currency, stick it in a safe. By the way, nothing is more deflationary than hoarding cash. That money has velocity of 0. You can have all the money supply in the world, but nominal GDP is money supply times velocity. This is just, quantity theory money. It's an identity. It's a truism. So if money supply times velocity equals nominal GDP and velocity goes to 0, your economy is 0. So money in a safe is 0 velocity. That's not a good sign.
So,
A couple of things you've got me a little bit confused on, so I'd like your help on them. First of all, you talked about the currency as a barometer of the economy. Now, obviously, if we take the yen and run it against European corporate CDS, we get a very, very close correlation. That's to say, if you take something that's a measure of stress in the system, then when the stress goes up, the yen strengthens. It's an incredibly reliable barometer of global risk appetite. So I'd suggest it's a bit like the construction engineer who turns around and says, I think we better stop digging. The architect might have the plans upside down there. On the other side, you were talking about having to increase interest rates to get foreigners to buy. Off the top of my head, the yield on the long bond was about 3% 10 years ago, and it's gone down to minus 10 basis points today, sorry, 9.7 basis points today.
Right.
Over which period the foreign ownership of the bond market has gone from, I'm thinking 2% up to today it's actually not 7% as the last person was saying, but 10. So if you can explain that as well, I'd be really grateful.
Well, part of that clearly is the Bank of Japan said they're going to buy an unlimited amount of them, right? So maybe that's people speculating on, hey, they'll keep coming, they'll keep having appetite. By the way, considering I'm very sensitive to my yen position, this is a random story, but everybody seems to like it. I have a rent house in Houston, Texas that I bought with my dad, and my mortgage is in yen. I got my mortgage through Bank of America. So I collect the rents from an oil field worker family, and I collect my rents in US dollars, and then I turn around and I pay my mortgage in yen. So as the yen weakens, I turn around and pay that off. So that and my hedge fund, I know exactly what you're talking about regarding the risk on, risk off sort of dynamic of the yen. No doubt about it. I've seen that happen in real time. U.S. stock market breaks several hundred points, and oddly the yen rallies. So I'm not saying that I don't notice it. I just happen to disagree with it in the long term. That's all.
I take no comfort from correlations. They're true until they're not. Everything at long-term capital management was based on the kinds of correlations, regressions, statistical probabilities that you're describing, and all of it failed at the most critical time. Things that, but the kind of analysis you're presenting, a statistician will take those correlations and they'll say, yeah, for this to go badly wrong, or for the yen to go down relative to some other index, or for interest rates to go in Japan relative to what's happening, that would be, a third standard deviation move, or maybe 4, and it could only happen once every, 100,000 years. Jamie Dimon recently embarrassed himself by saying that some things that happened in the London whale situation could only have happened once every 3 billion years, almost since the beginning of the planet Earth. I said, well, Jamie, you must be really unlucky for that to happen to you. But all of it is false science, because the degree distribution of risk in capital markets is not normally distributed. The entire framework of standard deviations and that those normally distributed statistics simply doesn't apply. And what happens is you take false comfort from what you're describing, and then it just blows up. It falls apart and gives you no comfort at all when your wealth is wiped out. So it's all backward looking. It doesn't take into account density functions, does not take into account complexity theory, does not take into account power curve, degree distributions of risk in capital markets. It doesn't take into account all the things that happen in the real world when things go bad.
So, and incidentally, I'm a physicist, so I'm reasonably happy with the mathematics of that.
You mean to tell me I'm arguing with a physicist?
You are.
This is, oh my
So,
God.
just to be sure about this, your response to the safe haven trade is to ignore it.
isn't that safe haven regarded as domestic? Isn't that Japanese funds coming back? I mean, isn't that the running home to mama idea? That, oh, if I'm risk off because U.S. is going down, then Japanese, well, that seems pretty reasonable to me. Is that, oh, you know, I've got to pull things in, I've got to come back. Talk about what we talked about in the car on the train on the way to Kyoto yesterday regarding the earthquake and how you saw capital flows there.
Our physicist, I'm sorry, your name, I missed it, Smith, or Dr. Smith here. Yeah, I mean, look, it's a painful reminder, but March 2011, we all know what happened. So you had an earthquake, which is actually the breakdown of a complex dynamic system. It caused a tsunami, which is the emergent property in another complex dynamic system. It crashed into a nuclear reactor in Fukushima, and the nuclear reactor is a man-made complex dynamic system, which melted down, which caused a crash in the Tokyo stock market, which is another man-made complex dynamic system. So it's an interesting example of two natural complex dynamic systems and two man-made complex dynamic systems feeding into each other. The complexity of any one of those breakdowns is sufficiently daunting to analyze and do the math on, but when one cascades into the other, and you had two man-made and two natural, that's an example of, so who would have said ex ante, you know, I think an earthquake in the bottom of the ocean over here could cause the Tokyo Stock Exchange to go down. But oh, by the way, we'll have a tsunami and a nuclear meltdown. You know, the probability of any one of those events is small. The probability of all four of those events in a causal chain is infinitesimally small, but it happened. And you know why. I mean, you understand emergent properties and complex dynamic systems. So, by the way, with regard to your remark, well, your response to this trade is just to ignore it. I don't ignore anything. My response to the trade is to not ignore it, to pay attention to it, but it doesn't mean I take any comfort from it.
Gentleman here. The floor is now open to anyone who has questions, by the way.
My name is Khalil. I'm Ambassador of Bahrain. I very much enjoyed your presentation and your last book, Currency War. You know, my question is, should your book be the old case of gold? Why I'm asking this question? You know, when measure things in physics or math, we measure by ruler. If I have a centimeter, I use the ruler to measure centimeter. Now, I thought currency should have a measurement, and the measurement should have been a gold. Now, the point is, if we concentrated from before on gold, we didn't avoid the problem of what you call it a digital wealth. We would have concentrated on physical wealth. Thank you, sir.
Well, first of all, Ambassador, thank you for that question. I just want to say that Bahrain is a beautiful country. I've had the privilege of visiting there many times. And when I go there, I'm especially grateful for the degree of religious tolerance in Bahrain, because I'm a Catholic and it's a Muslim country, and I'm able to go to a Catholic church while I'm there. So I'm very, very grateful for that. But I love going to Bahrain. It's a great country. I'll say, took the words out of my mouth, because I use, if I didn't know better, I'd say you read my book, but it's not out yet, so I know you haven't. But you put your finger on one of the most important questions with regard to the role of gold as a currency. And the French word for this is numéraire. In other words, what you said, centimeters or rulers, you know, in American football, we have a football field, and if I send two people out, I say, I want you to measure the field and come back and give me the answer. And I give one of them a ruler and one of them a yardstick. And they both go out. One comes back and says, it's 300 feet long. And the other one comes back and says, it's 100 yards long. Well, is it 300 or 100? Well, the answer is it depends on what you're using to measure. What is the numeraire? And one of the biggest flaws in thinking in capital markets, in my view, is that we have privileged the dollar. We have said the dollar is the numeraire. Now, I wouldn't mind if the dollar was the numeraire, if the dollar were anchored to something, if it were a stable source of value, but it's clearly not, and it's not by design. Since 2010, the beginning of the cheap dollar period, and it got a lot stronger since 2011, but 2010, 2011 was a clear effort to cheapen the dollar to give the U.S. economy a boost. So we have a measuring stick called the dollar that's not a measuring stick, because it changes in length. So what is the right numeraire? And I have this argument all day long, because people say, you know, gold went up. You know, it was $1,200 an ounce, it went up to $1,250, and then you say buy gold, and then it goes down to $1,190, and you go, you're an idiot, you know, because it went down to $1,190, as the case may be, and you know, and the gold's going. I said no, gold is constant. Atomic number 79, specific gravity 19, means it weighs 19 times the weight of water. It's one of the most constant things I can think of. When people say the price of gold went up or down, I say no, the dollar went up or down. And there was a higher dollar price of gold just means the dollar got cheaper. It takes more dollars to buy my gold. A lower dollar price of gold means the dollar got stronger. It takes fewer dollars to buy my ounce of gold. If you make gold the numeraire, if you make that your constant, then volatility in the dollar price of gold is really volatility in the dollar. And that's how I think about it. I think of gold as a currency. It's competing with yen, yuan, euros, Swiss francs, dollars, as the case may be. Think of gold as a currency. Think of it as the one that doesn't change in terms of its inherent properties. And then you can begin to understand that fluctuation in the dollar price of gold, the dollar price of gold has nothing to do with gold. It has to do with the instability of the dollar. So I agree completely with the inference of your question, and I think that's actually the most sophisticated understanding one can have about the role of gold.
Can I ask a question to a different topic? Going back to the when you were a consultant for the CIA and the Pentagon, and you were asked to look into that possible insider trading before the 9/11 attack. My understanding that was in the shorting of airline stocks. Did you ever come to any conclusion on that?
Sure. It was. I did work for the CIA in that capacity, and it was not the possibility of insider trading ahead of 9/11. It happened. It was very well documented. There was insider trading in advance of 9/11. Now, who did it? That's a separate issue. How did it play out in markets, et cetera? Those are all those important issues. It was effect shorting. The way it was done, the perpetrators bought put options on American Airlines and United Airlines, but this is a financially sophisticated group, so you know buying a put option is the same as shorting the stock, but it doesn't technically involve shorting. And we, when we looked at this in the CIA, we were not cops, and it was really up to the FBI and the SEC and the Department of Justice and others to get to the bottom of that crime. What we wanted to do, our interest was, okay, that happened. If there were going to be another spectacular terrorist attack, something on the order of magnitude of 9/11, would there be insider trading again? Could you spot it? And could you spot it in time and trace it to its source to break up the plot and save lives? That's what we did. This is called Project Prophecy. And we years of study and a very large team, including Nobelists and physicists and mathematicians and lawyers and market experts and computer experts and other resources of the agency. We worked on this, and we concluded that yes, it would happen, B, that you could spot it, and C, that you could trace it to the source, get a FISA warrant, break down the door, and break up the attack. So that was what we did, and we actually later turned that into a working prototype of a machine that could identify this. This is all described in Chapter 1 and Chapter 2 of my second book, The Death of Money. We haven't really spoken about that, but it's all in there. But as far as the trading before 9/11, just to speak to that for a moment, we initially encountered great skepticism inside the CIA. I mean, one of the reasons I was recruited to help do this was because they didn't have capital markets expertise. And I give the CIA a lot of credit. They're very good at outreach. Like, they know what they don't know, and so when they need to know something and they know they don't know it, they'll go find those people. There's an old saying, when it comes to working for the CIA, you don't find them, they find you. So they found me, and again, I teamed up with others to get to the bottom of this. But when we laid out this hypothesis, some of the career analysts and what we call senior management were highly skeptical. They said, wait a second. You know, the terrorists would never jeopardize operational security by doing insider trading before an attack. I mean, they're smarter than that. And I had a two-word answer for them, which was Martha Stewart. Martha Stewart Martha Stewart made $1 billion honestly. She was not a crook. She made $1 billion with creativity and hard work, and ended up behind bars on $100,000 inside trade. By the way, just to be clear, she was not convicted of insider trading. She was convicted of line to federal officers and things like obstruction of justice under Title 18 of the United States Code. So, here's a billionaire who ends up behind bars for 100 grand. This shows you the power of inside information. Basically, people cannot resist betting on a sure thing, number one. Number two, nobody said, I certainly didn't say, that Mohammed Atta, on his way to Logan Airport to hijack a plane, stopped at Charles Schwab to put in a few orders. That never happened. But what you have to understand is that even terrorists exist in a social network. Believe it or not, they all have mothers and fathers, sisters and brothers, aunts and uncles, associates. There's a safe house operator, a driver, there's a cook, there's a financier. They exist in these social networks, and people in the social network might not know the exact details of the attack, but they might very well know that, you know, September 11th is the day, or this is going to involve the following airlines, or, you know, maybe a little more detail than that. And that's the point at which the $20,000 a year driver who's on the Al-Qaeda payroll is saying, if I take $5 grand. By the way, insider traders always go to the options market. I mean, Trey knows this as well as I do. You always go to the options market because it has the most leverage. You know, if you buy $5,000 worth of stock and it doubles, you make $5,000. But if you buy a $5,000 call option and the stock doubles, you make 10 times your money, or whatever it is based on the option pricing. So they always go to the options market. That's the first place you look. It's somebody in the social network. So our task was, it wasn't that the terrorist operative was going to do the trade, it was that somebody was going to do the trade. And could we spot it, and then based on that, break down the door and undo the plot. So that was what we uncovered with regard to 9/11. But our main job is to be clear, as the CIA is not a law enforcement agency and does not have domestic surveillance powers. It's an intelligence agency that should lean forward, look forward, and sort of concentrate on the foreign map, and that's what we did.
Okay, thank you. Any more questions from the floor? We've got time for one more. Yes. There's a microphone right there. If you.
Hi, Sachiko Oi. I'm a hedge fund consultant. I have a question. I read your book,
Thank you.
The Death of Dollar, and you mentioned about SDR and also internationalization of renminbi. So do you think now internationalization of renminbi is not possible because you focus on simply dollar for the next book?
Right. The internationalization of the yuan or RMB or renminbi is proceeding, but it's proceeding very slowly. And it's very clear that when the IMF included the yuan in the SDR basket, which, by the way, itself is a move that's not that well understood, because you run into experts all the time that go, you know, there's SDRs. First of all, SDR, special drawing right. I call it world money. The IMF doesn't call it world money because that's too spooky, but that's what it is. They always give these things funny names so people won't know what they are. Like, why do we call our central bank the Federal Reserve System? Because if you called it the central bank, Americans hate central banks. We had two of them when we got rid of them. The one before we got rid of in 1835, 1836. So Americans hate central banks. So when the power release decided to start a central bank, they said, don't call it a central bank. So they call it the Federal Reserve System. SDRs are the same thing. Don't call it world money, call it the special drawing right, so it'll hurt people's heads and they won't know what it is. That's the SDR. Now, people say, well, there are five, we're four, now five currencies backing up the SDR. It was dollars, euros, sterling, and yen were the four currencies, and they've announced that they're adding yuan. It's not done yet, by the way. The announcement has been made, but the effective date is September 30th, 2016. So Chinese still have to be on their best behavior for at least 6 more months. But the history of the Chinese is to play by the rules until you get into the club, and then show up in flip-flops and cutoffs. I mean, they get in the club, and then they break the rules once they're in. They did it with WTO. I'm sure they'll do it with the IMF. But they're not there yet, so they're still on their best behavior. Now, people say that the SDR is backed up by these 4 or 5 currencies. It's not. There is no pot of hard currencies backing up an SDR. Those currencies are included for the sole purpose of a simple mathematical calculation as to the value of an SDR. So if you say, well, what's an SDR worth? Well, today it's worth about $1.45. It fluctuates between $1.35 and $1.55. It's just another cross rate. But you get to the answer, $1.45 or whatever it is, by doing a math problem that includes the currencies we mentioned. But that's that's it. That's all it's for. It's not backed up by anything. It's just fiat money. As far as the Chinese are concerned, this was a highly political decision. Clearly, how can you have the world's second largest economy, world's fastest growing major economy, not in the club? You sort of can't have them not in the club. So you had to let them in, even though they didn't qualify by the normal standards of the IMF, and those rules were bent to allow them in. But the actual internationalization, they're making some strides as a trade currency, but there's a big difference between a trade currency and a reserve currency. Trade currency can be anything. It can be bottle caps or baseball cards. I mean, you and I, it's just a way of two countries keep score periodically. I'm ahead, you're ahead. We settle up probably in dollars, truth be known. That's what a trade currency is. It's in flows and invoicing. A reserve currency needs something else. A reserve currency needs a bond market. Reserves are your savings, right? For a country, you run a surplus, it's your savings, those are your reserves. You need to invest it in something. You're only going to invest in relatively deep liquid markets. There is no deep liquid market in Chinese sovereign bonds. That market doesn't exist. And until it exists, the yuan will not be an important reserve currency, although I'll grant that it's growing, and you'll probably see you know, I don't know, IBM and General Electric and Caterpillar and you know, Sony and some of these companies start to issue, you know, yuan bonds, and then the Norway Sovereign Wealth Fund will buy some, and that'll grow, but it's happening very slowly. But this was a political accommodation, and you know, it doesn't. It's likely. The one thing I hear a lot is, you know, of course the Chinese are secretly buying thousands of tons of gold, and that's not a mystery. I mean, there's hard data. Their Chinese annual mining output is 450 tons a year. The Hong Kong data is relatively good, so we know they're bringing in about 1,200 tons a year via Hong Kong. So right there, that's almost 1,700 tons a year, not counting what the People's Liberation Army is bringing in overland. I've spoken to secure logistics people who have said they've been in, you know, armored vehicles coming in through Central Asia. So I don't know how much gold is there, but even if you said 1,800 tons a year by 5 years, that's, you know, 9,000 tons, probably longer at this point. So 6 years, that's well over 10 tons of gold. What's harder to get a handle on is, of that gold, how much is private consumption, how much is going to the People's Bank, well, SAFE, State Administration of Foreign Exchange, because they keep it off the books at People's Bank of China because they lie about how much gold they actually have. So that's hard, although I had dinner recently with the head of the world's largest gold refinery who supplies a lot of China's gold. He had just come back from China. He told me that his estimate was, I had done 50-50, which is just a priori assumption based on best information using Bayes' theorem. But he gave me reason to believe that the number was more like maybe 70% retail and 30% government. So based on that, I lowered my government estimate, which means that they are still at least 3,000 tons away from matching the United States. That's a lot of gold. So that means China is going to keep buying gold, which means there'll be reason for the Chinese at least to want to use the gold futures market to manipulate the price to keep the price down. Everyone's like, if you had so much gold, why would you want a low price? It's like, well, if you're not done buying, you definitely want a low price. So, you know, gold's another tug of war between supply and demand in the physical market, competing as a currency among currencies, the fear trade, the inflation trade, and the China trade. So it's a crazy mixed up market.
Okay, we've reached the end of our conference. My last act here is to offer our two speakers a 1-year honorary membership of the FCCJ. And if we can have a warm thank you to our speakers today. Thank you very much.